Hello, and welcome to the 2021 First Quarter Investment Webinar with the San Diego Foundation. I'm Brian Zimbano, Vice President, Chief Development and Stewardship Officer. Thank you for joining us today. These quarterly investment calls are an enhanced service to our donors. They provide direct access to our investment leadership in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Today, we'll start with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, sustainable portfolio, and our long-term, medium-term, intermediate-term, and short-term portfolios. We will conclude with a question and answer session. To submit your questions, please use the chat function on the menu bar below at any time throughout the webinar. Any questions unanswered during today's webinar will be answered via email. Attendees can also access slides and recording of today's call at our website at sdfoundation.org by tomorrow. Leading today's discussion will be Kevin Hamilton and Matt Fettig. Kevin serves as a business consultant and advisor in the investment management industry. With more than 30 years of business and investment experience spanning both institutional and wealth management markets, Kevin has a deep understanding of the asset management business. Most recently, Kevin was managing director at Rosemont Investment Partners, where his responsibilities included portfolio construction and management, deal sourcing, and evaluating prospective investment. Since 2014, Kevin has served on the investment committee of the San Diego Foundation and is currently serving as the fiscal year 20 vice chair. Kevin?
Thank you, Brian. Hello, everybody. Glad that you could join us. I'm going to make a few introductory comments, and then we'll hand it over to Matt Fettig to talk about performance of the various portfolios. But on this first page, we've shown you this page before at different times, and this page shows the annual returns of the S&P 500 in those bars compared to the biggest drawdown point that the market experienced during that year. And as you can see, even in up years, markets tend to experience fairly significant drawdowns. The snapback, the drawdown and snapback we had last year, however, I think is the biggest on this chart as far as the drawdown being 34% down as COVID got into the system in the first quarter of last year, and then closing up 16%. That's the S&P 500. And by the way, that's a price return. I looked at these and thought these were a little light. The total return of the S&P 500 was about 18.5, so 2.5% or so greater. That is about a 50 percentage point swing from trough to the finishing close. And that's the biggest that I've seen in my career. 2009 came close at down 14 versus up 29, but it was really quite a roller coaster year. And here we are following it up after the first quarter with the market up a little bit more than 6 at March 31st. So you know, in this volatile type of time period, it helps to have a disciplined process. So, you know, unlike many investors, we spend a lot of time on structure, discipline, how do you respond to different environments? And so we were naturally rebalancing into areas which had declined around the first quarter, and nothing earth-shattering about that. It's just the way we do things. We didn't particularly know that we were going to get that snapback, but that type of rebalancing helps generate good long-term returns over time. Next page, please. So here's a chart that shows you unemployment and wage growth over a long period of time back to the 70s. And hopefully we never see a spike like what we saw last year again. I don't think that has ever been seen before in terms of swiftness. So we went from pretty much a full employment state to almost 15% unemployed by April of 2020. And as the economy adjusted and as the the pandemic started to lessen, you can see that unemployment dropping back down to a still quite high level at around 6 or so percent. Normally, everybody would be worried about 6% unemployment in a normal cycle, but considering where we've been, nobody's too worried about it right now. You can see the same kind of pattern with a little bit of blip in wage growth and some acceleration of wage growth, which you'd say, with unemployment that high, there ought to be a lot of slack. How is the wage growth being generated? But there's a difference between that average unemployment and where the jobs are needed, and there always is, but that's a little bit of what's going on here. So the wage growth in areas where there's significant employment demand is showing up much faster than the unemployment rate dropping. So next slide, please. So interest rates and inflation. First off, I mean, take a look at the long-term decline of nominal treasury yields, and the gray is real treasury yields over a very long period of time, long secular decline, driven by broad economic as well as social factors over that time. What you read about in the press today is, gee, inflation. Everybody's scared of it. Everybody thinks it's picking up. And you can see that it in fact has, in the sense of the chart at the top, through March 31st, you don't get a lot of inflation, but if you look at what's going on in the economy right now and the recent CPI numbers that have come on, they're significantly higher than that. And bond yields have also risen pretty dramatically off of a very low base. But when you look at where it is relative to the past, you have to conclude that bond yields are still at very low levels, as is inflation. What people are worried about is that during the pandemic, we all saw this in retail stores, but it went on throughout the economy. In any recession, but especially a steep one like this, how do businesses respond? Businesses respond by drawing down inventories and not replacing it because they're trying to conserve cash and they don't see the demand, okay? So now you have enormous pent-up demand as the economy is opening back up. Lots of surveys are supporting that. And how are businesses responding to that? Well, they've got to rebuild inventories, and they've got to do it all at once across the whole economy. So during this inventory rebuild period, you're going to see some pricing pressure on a lot of things, everything from commodities to gasoline and so forth. But the question, the $64 question, if you will, is this going to be strong enough to change that long-term secular trend you see on this chart of generally declining yields and declining inflation over time? It's a little hard to assume that it will, because cyclical factors of a short-term nature like this tend not to be able to change the long-term secular structural pattern that an economy has been in. Now, this one might be different. Government has never printed more money than what they have in the last year. And that money is going to have to be financed over time. And so people are legitimately worried that interest rates will have to rise. But not a lot of support for really changing the long-term structure of the market at this point, at least in my view. So what else are we looking at? Bond yields extremely low. Hard to meet long-term return objectives in the bond market these days, and especially if yields are going up, which is going to create pressure on bond prices. So this chart is a chart that compares the expensiveness, if you will, of international stock markets to our stock market. And this is an interesting chart. The first thing that you can see is that little average line in the middle, minus 12%. That means on a price earnings ratio basis over a long period of time, the international markets are always cheaper, so to some extent. And you can have a lot of arguments as to why that would be the case. Quality of earnings, economic growth rate differentials amongst the developed countries, including the US. But what you see now is that cheapness has gotten much cheaper. PEs are about 25% or so cheaper internationally than the US is. So you can buy the same dollar of earnings, if you will, for a lot less. And in addition, weakness in the dollar has the potential to accelerate the price return of foreign markets, international markets, when you account for currency. So that's just a way of saying what kinds of opportunities are we looking at? We have a very healthy allocation to international markets right now. We're not cutting that back. If anything, we'd be increasing it when we have opportunities. And it's another good example of paying attention to long-run relationships and then thinking about how our assets, which are long-run in nature, can respond to that in a successful and rational way. So that's the end of my comments. I think I'm going to hand this over to Matt and let him update you on the returns. I will make one quick observation, and that is that with all of these return dates being March 31st, this 1 year period is a 1 year period right after that 34% drawdown that I talked to you about. Hence the snapback, and you'll see that not only in our portfolio, but in a lot of different capital markets as well. Always helps you out in investment management if the comps are good, and the comps are good in a year like down 34 last year, regardless. So Matt, take it away.
Well, thank you, Kevin, and good afternoon to everybody. Thanks for joining us today. It certainly was quite a 1 year period with the market bottoming in March 23rd of 2020. This 1 year period, we had to adjust the axis to get this bar chart to fit. And I will just throw out the old disclaimer that this 1 year number is not repeatable year in, year out, and it's not something you should expect to see. Our longer term numbers, I think, are more indicative of what we would expect going forward. So there were some themes in the first quarter that I'll talk about now and provide application to each of the portfolios as we go over them. But I think they're important to note. Really starting back after the election in November 2020 and the rollout of the COVID vaccines, the market, particularly in the US, even abroad, shifted quite a bit. So with rates near zero, and even longer term rates very, very low at historical lows. For the last many years, it was these growth oriented companies, the Apples and Amazons of the world, that were really dominating the performance of the markets. In fact, it was just a very small handful of stocks that was producing almost all of the positive performance for the markets. And if you didn't own those names or you weren't overweight those names, your performance suffered, quite frankly. But in November, there was a rotation, and that rotation really fed into this idea that the vaccines are here and the economy will reopen. And as a result, we saw people pulling money out of those growth stocks that had worked so well for years and into what I'll call early stage cyclical recovery companies. Most of those were trading at fairly depressed valuations, or at least average valuations. And it caused this rotation into what we call value stocks. And that rotation has largely continued since November, though it's taken pauses along the way. So with that, that's an important theme to note, because it does indicate that the market is broadening out, which I think is a good thing. And when we do look at valuation measures for the US market, it does appear to be slightly overvalued, but it may just be those handful of names that had gone up so much that led to that. So the other theme I want to mention, and if we think back to Kevin's presentation on interest rates and inflation, is we had one of the first quarters in some time where longer term interest rates increased, and therefore the bond portion of our portfolios decreased in value. Remember, bonds have an inverse relationship with interest rates. So if interest rates go up, bond prices go down. And so the first quarter was a quarter in which we had fairly robust returns out of risky assets, but actual negative rates of returns from the bond segment of the portfolio. So how does that apply to the endowment? Well, we obviously have a healthy allocation to stocks. Stocks led by the US market continue to be one of the best drivers of performance for the quarter, certainly for the last year, and the 3-year, 5-year, 7-year, and 10-year numbers. You can see the sleeve of international equity that we have, 18.2%. I think the last slide that Kevin talked about shows that relative valuations can continue to favor these non-US companies. But that said, there are specific reasons, COVID being a big one, where there's a lot of variation from country to country. Economic growth rates are different. Some are still facing waves of COVID, while we're in the US, we're in the process of reopening. So it may take some time for that to play out, but we continue to keep a relatively healthy allocation. You can see our bond portfolio noted on here in the gray as domestic fixed income, and there's a little teeny sleeve of dark blue next to it, maybe that's black, global international fixed income. It's about 15% of the portfolio. And remember the old days when an endowment was invested about 60% in stocks, 40% in bonds. You know, with interest rates where they are today, holding any amount of fixed income or bonds when you're trying to generate a long-term rate of return of CPI plus 5%, it proves to be a very, very difficult endeavor, simply because bonds have been priced to perfection. And so that is a segment where we are actively looking, as other investors are, for alternatives. There aren't very many good ones, I can tell you that, but we may come back to you in the future with a possible small marginal solution that we've been talking about at the investment committee level. Other segments of the portfolio performed well. Our private equity and private credit books performed very well. Real estate performed very well. Hedge funds with the really return to value-oriented stocks performed quite well for the first time in some time. You see, we did lag our policy index for the one quarter, and that was primarily due to the private equity segment of the portfolio. At the end of each calendar year, private equity managers go through a financial statement audit, and it really delays the timing of the release of some of their performance data. And as a result, as at the time we're reporting to you today, we do not have all of our private equity results in, and so we expect to close the gap here between our performance and that of the policy index. But with that said, you can see a very strong 1-year return, and over the 5, 7, and 10-year periods, strong results, beating our mandate of CPI plus 5%, and either in line or ahead of our policy index. Let's flip to the next page here. The long-term portfolio is positioned much like that of our endowment. The big difference is we promise our donors that are invested in this portfolio liquidity to make grants. And so we're limited in terms of the liquidity that we can, or the illiquidity, I should say, that we can have in this portfolio. Very similar results to what we experienced in the long-term portfolio. Heavy weighting to stocks, certainly US stocks led the way. An allocation to fixed income, you can see it's at 19% today, and a sleeve of real assets. And we'll talk about what those are in a little bit greater detail later. Next page. Medium-term portfolio. This is a very, very interesting one, and I'm going to repeat myself, and I apologize, but look at the 1-year return here of 19.5%. This portfolio is about 30% stocks, 65% bonds, and 5% cash. And I'm not sure that we will ever see another period where stock markets appreciate so as great as they did over the 1-year period. Rates fell to zero, so bond prices appreciated, and this portfolio produced such a strong return. Again, I don't think that's repeatable. In fact, with interest rates where they are, I'd say the prospect for future returns from this portfolio is probably a bit lower, more in the 3 to 4% range over time, than certainly what you're seeing over this 1, 3, and kind of 5-year period. So very, very strong results driven by the decline in interest rates throughout the year. You can see for the quarter, it just almost flat, marginally positive performance. Stocks worked well for the quarter, but as interest rates started to creep up, bonds produced a negative rate of return. So next is our intermediate term portfolio. This is a new portfolio we launched on January 1st of this year. And why don't we flip to the next page first? We're going to go in reverse order here. Our short-term portfolio has been around for some time at the San Diego Foundation, and it's invested purely in money market funds. Money market funds are highly correlated to short-term interest rates. And so as short-term interest rates went to zero, the yield we receive on this fund also went to zero. And we have quite a few donors in this portfolio that aren't interested in taking any risk with their charitable dollars. And that's just fine. But we do want to set the proper expectation that it could be some time before short-term interest rates rise. And therefore, if you are invested in this portfolio, you're likely to earn a 0% rate of return. Now, if we go back up a slide, in response to that fact, we thought we'd create a new portfolio that is 100% invested in bonds that could produce some amount of yield to offset the fact that the short-term portfolio is delivering nothing. And so that's exactly what we have here with our intermediate term non-endowment fund. Now, it does not have any stocks, so there's no correlation to the stock market. Keep that in mind. But bonds do have a negative inverse relationship with longer term interest rates. And so as we talked about this theme of longer term interest rates moving up during the quarter, this portfolio ended up producing a negative rate of return. So I think it's important to note, if you're sitting in our short-term portfolio, it's really, you're not taking any risk that the price of your money market fund is going to vary. Here you are taking some risk. The potential range of outcomes are probably a lot tighter than they would be for the medium-term or long-term portfolio, because stocks tend to be volatile, and this portfolio doesn't have stocks. But that's not to say that this portfolio doesn't have risk. It has risk, and the risk is that if interest rates continue to rise, then bond prices may fall. If you have any interest, if you are in the short-term portfolio and have an interest in possibly exploring this new portfolio, please talk to your donor manager. We'd be happy to set up a call to pursue that. If you're comfortable not taking any risk and earning a 0% rate of return, and you're in the short-term portfolio, then that probably is the best place for you. Now, likewise, about, I guess it's 5 quarters ago, January 1st of 2020, we also created 2 new portfolios for our donors that were focused on adding a sustainability element to their investments. And we have 2 portfolios. We have an endowment version and a non-endowment version that are effectively managed for now in the same fashion. And we call these our sustainable portfolios. What does sustainable mean? It means that the investment managers that we hire follow strict environmental, social, and governance criteria when selecting stocks and bonds for this portfolio. We also ask our managers to take the environment portion one step further and divest from companies that produce fossil fuels. A very strong rate of return here for the 1-year period. What I don't want to do is set the expectations that the sustainable portfolio will do better than our regular endowment because of the ESG considerations. Last year was kind of a perfect storm where the worst performing sector of the stock market was energy companies. By the nature of this portfolio, it doesn't invest in that segment, and therefore was able to produce very, very strong rates of return over the 1-year period. During the first quarter of 2021, you saw energy companies catch a bid as commodity prices rose. And so you can see that in the first quarter, it was actually a detractor not having those energy stocks. And this is the non-endowment version, essentially the same, invested with the same exact managers, 70% exposure to stocks, 30% exposure to bonds. You can see our weightings are slightly off from that 70-30 mix, but I believe we were in the process of rebalancing the portfolio at this snapshot in time. So those are my prepared remarks. I'll hand it back over to Brian, and then I'll lead some Q&A.
Thanks, Matt. Thanks, Kevin. As a reminder, you can post any questions you may have in the chat section now. We had a few coming into the webinar today, and I will throw it back to Matt to see what questions we may have for the group.
Thanks, Brian. So the first question we have is concerning that topic of inflation, and how do we think about hedging our portfolio or having assets in our portfolio that may benefit or protect the portfolio from inflation. And I suppose that's a question I can take. Inflation is certainly a risk that we have to consider for our longer term assets. Over time, we're really seeking to have a rate of return in excess of both inflation and our spending rate in our endowment portfolios. And so if we have inflation that tends to be quite a bit higher than what we've witnessed over the past several decades, we do want to have assets in our portfolios that protect in the event there is inflation. And there's several ways you can go about doing that. We've developed a sleeve of both the endowment and long-term portfolios called real assets. And the concept behind real assets is that these are tangible assets. Oftentimes, the first thing I think of is something like a commodity, oil and gas commodity. And to be frank, that is not exactly what we're looking to do. We have about 6% of the endowment portfolio invested in a diversified real assets program, but we're seeking to further diversify that into what I'll call illiquid or private opportunities. And Kevin was kind enough to remind me
I could interrupt. Maybe Jenny could go back to the endowment slide that shows the allocations.
And while she's doing that, I'll continue.
Okay.
We invested in a manager recently, and I thought I'd just share it by way of example. We found a small investment manager called Vision Ridge. Back to the endowment slide, if you could, Jenny. There you go.
There you go.
So you see this exposure to real assets on the left-hand side of the pie chart, 6%, the gray sleeve. We're supplementing our diversified public real assets book with privates. And these private opportunities, for example, Vision Ridge, raised about $1 billion. They ended up being highly oversubscribed at $1.25 billion, which was the max their documents would allow. We were able to get an allocation to this highly oversubscribed fund. And they are launching what they're calling their Sustainable Asset Fund number 3. And it's a very compelling opportunity when you traditionally think about commodities as an inflation hedge. Well, commodities can tend to be assets that are not in favor today because they're tied to commodities, and the commodities can be tied to things like climate change. The Sustainable Assets Fund 3 invests in things like commodities, but it actually invests in segments of the market like water, solar, transportation, energy efficiency, and tends to be very ESG, environmental, social, and governance friendly. And I think that's an approach that we like and that we will continue to take over time as we build out our exposure to this real asset category. The other segment of the portfolio that we have is real estate. And real estate, again, a tangible asset that tends to do well during periods of inflation as you have home appreciation, building appreciation, what have you. Now, the fundamentals of real estate are a little bit mixed today, given COVID, but we are picking our spots and believe that we can generate some very attractive returns. from that segment of the market as well. Kevin, did you want to weigh in?
I would. When you look at this chart, which one of these pie slices has the most sensitivity to accelerating inflation? So that would be domestic fixed income, and in particularly high grade treasury type fixed income. So the challenge, Matt described one good way of trying to offset that risk in that portfolio. The challenge in the fixed income space also is that you can go out the credit curve, right? Corporate fixed income, higher yield fixed income. Well, the spreads there are so narrow relative to treasuries that, you know, a lot of times that would be another way to go. Well, that doesn't work very well now either in the domestic fixed space. So if you can't take duration risk because you're worried about interest rates going up rather than down, and if you have a hard time taking credit risk in the public markets, then the other area that you can start to think about is how much liquidity risk can you take in an endowment portfolio that is really a perpetual asset. You can have a reasonably decent portion of that portfolio in securities like what Matt described on the real asset side, which is a private investment that is locked up over a period of years. You can also do the same thing on the fixed income side, and that's something that we are looking at as well. We've got a little tiny allocation to private credit right now that we've had for some time, but when you can't take duration risk and you don't want to take much in the way of public spread risk, the spread that is fairly consistent over time is the illiquidity premium that you can earn by going out and doing the right kind of private lending in a variety of different situations. So that's something that we're looking at closely. I wouldn't be surprised if that allocation winds up growing a little bit over time as well. So one more way that we are trying to manage that, Matt.
Thanks. Appreciate it, Kevin. I don't believe we have any more questions at this time. I'll turn it back over to Brian.
Thanks, Matt. Thanks, Kevin. Thanks, everyone, for joining us today and for partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation will be available on our website at sdfoundation.org/investments. Thanks again, and have a wonderful day.